Let's move on with equity portfolio management. Dr. E is going to impart some of his equity portfolio management wisdom on you. All right, so when you're an equity portfolio manager, when you're a portfolio manager, one of the big questions is, what is your role with the client? Okay, so when a client comes to you, one of the questions you ask is, how does the investment portfolio that you are being asked to manage fit into the overall financial plan of the investor? If that portfolio is if that portfolio constitutes a very large portion of the investor's wealth, then the manager should try to diversify that portfolio into several asset classes like stocks, bonds, commodities, real estate, different asset classes. Diversify that portfolio by location, including international securities and domestic securities. Diversify that portfolio by style, including growth and value. And lastly, diversify that portfolio by size, including large, medium, and small cap stocks. And you diversify the bond portion of the portfolio in a similar way into lots of different types of securities. And we'll get into bond portfolio management in the next chapter. Okay? However, if a client comes to you and the portfolio that you're supposed to manage represents a smaller portion of the overall wealth of the investor, then the manager can take on more risk if the client is agreeable. So what is the client asking you to do? To build a diversified portfolio, or maybe to manage one piece of a portfolio that represents one exposure, maybe small cap growth, or large cap value, or U.S. stocks only. So really, your role as a portfolio manager depends on what the client is asking you to do. A primary way to ratchet up risk in a portfolio is to concentrate investments. Okay? Don't diversify. Examples include focusing on one geographical area like the U.S., one size sector like large, medium, or small stocks, or on one style like growth or value. If you want to try to ratchet up risk, increase risk, then concentrate your investments, less diversification. Another way to modify the risk of a portfolio is to use futures and options in the portfolio. And so, as a client, as an investor, you need to be careful when you're talking with a manager or when you're buying a mutual fund. You need to be careful to see if futures and options are being used to change the risk and return profile of the portfolio. Okay, that is a question to ask as an investor: are futures and options being used? The benefit of using futures and options is leverage. All right, leverage allows you to control a large volume of securities with a much smaller out-of-pocket expense. For example, you might spend $5,000 to own an option which controls $50,000 worth of stock. Okay, so you're using a small amount. Make sure I get this right. You're using a small out-of-pocket cash outlay in order to control a large volume of securities, a large value of securities, and that is leverage. Other advantages of using futures and options: low transaction costs. You can control a large volume of securities with one contract purchase, and quick execution, so it doesn't take you a long time to assemble the control that you want over the asset. Okay? There are two ways that options and futures can be used to control risk. One is to amplify returns or risk. The other is to hedge or to lock in returns on assets that have already been earned. So the returns have already been earned and you want to lock them in. So you can either amplify risk and return, or you can control, manage, or decrease risk and return. All right? Using options on securities that you already own can have a one-sided effect on expected return if you buy or sell options that move in the opposite direction of the price of the underlying asset. This is called hedging. So the underlying security that you own moves in one direction, up or down, and the option or future that you buy or sell will move in the opposite direction. This is hedging. So two basic strategies for using options to lock in returns on securities you already own include buying a covered put. Covered means you already own the underlying security, like a stock, okay? Buying this put will eliminate downside risk. It will not amplify returns, it will lock in returns, okay? If the price of your underlying security goes down, the price of the put goes up. This locks in. The other strategy for helping to hedge returns is called writing or selling a covered call. So you own a security and you sell a contract to another investor that says you will sell that security to them at a certain price. And if the price goes up, that's good for you unless the buyer of the contract decides to exercise the contract you have sold, and then you will lose your security. So why do you do it? Because you get money for selling the contract, and that helps you with your return. So if you think that a security is not going to rise in price, you can sell a covered call. All right? Let's see. Let's go into futures. Futures have a similar potential impact on the potential return of a portfolio. Like options, the key to the impact they have on returns is the direction they move in relative to the underlying security. Do they move with the security or in the opposite direction of the security? So you can use them to amplify returns or to lock in returns that have already been earned, just like you can with options. So let's look at futures a little more closely. Buying a future is the equivalent of subtracting cash, using your cash, and adding exposure to the asset. So if you buy a future, you think that the security price will go up, and so you're trying to participate in that. You own the security, you own the underlying asset, and you want to own more of it. And a quick way to do that is to buy the future. Okay? So this would amplify returns if you were already long. Selling futures is the equivalent of adding to cash. It's like selling a covered call. You sell a contract to someone else, and you reduce your exposure to the asset. And so this would hedge or lock in returns that you already own. Okay? So if you already own security asset that has gone up in price and you want to lock it in, sell the future. If you want to amplify, you think the price is going to go up, then you buy the future. All right. To modify the systematic risk of your portfolio, you could buy or sell market futures or options. Futures on the market. And this would increase your exposure or decrease your exposure to the market that you're in. Okay? This enables a manager to quickly increase or decrease the beta of the portfolio, and it increases the leverage of a portfolio. So it amplifies returns. To modify unsystematic risk, which is the risk related to a specific security, okay, you can use options on individual securities, okay, to increase or decrease exposure to that security. So what is it you're trying to accomplish? Do you want to increase beta, or do you want to increase a portfolio's exposure to a specific asset? Okay, so if you want to increase beta, then you buy a market option or future. If you want to increase company-specific risk, then you buy an option on an individual security, not on the overall market. Again, the leverage associated with options and futures enables investors to increase or decrease exposure to an asset or a class of assets with very limited cash outlay. That is the purpose of the leverage. Rather than buying or selling individual securities or options on individual securities, you can use futures or options that represent the entire market you're interested in, like the S&P 500 and or futures or options. Okay? So you could also, if you wanted to do it this way, you could also buy an index fund or an index ETF. So these options are cheaper, quicker, and less security specific. For example, let me explain to you, this is really the bottom line with using market futures and options. Let's say that a large contribution comes into your portfolio, okay? You want to have it quickly exposed to the market. You don't want that money lying around in cash. So let's say you manage a portfolio for a client and the client decides to double or triple the size of that portfolio and gives you a bunch of cash. It's going to take you time to invest that individual portfolio. So one thing you can do is you can take all that money and throw it into a market index, a future or an option or an index fund, and put that money to work immediately, and then you can take your time deciding how you want to allocate that money into individual securities. Okay, so you can use these market futures and options instead of buying individual securities. So you can put that money to work, lower the risk of being out of the market, and then take your time to buy individual securities. So you can go through, identify the individual securities you want, how many you want, what weighting for each security, and then you can go ahead and do individual trades without missing out on what might happen in the market. All right, so that's the end of this clip, and we're going to take a quick break, and we'll finish out this chapter. Shalom. Peace.